Good morning and welcome to the River UK Microcap Limited quarterly investor update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to Lucy Draper, Director, Investment Trust Sales. Good morning.
Good morning, everyone, and thank you for joining us today. I just want to give you a quick refresh on the River UK Microcap before I pass over to George. As I'm sure a lot of you are aware, the River UK Microcap IPO'd in 2014 at around 70 million, investing in listed companies sub 100 million. It has a unique redemption facility that is triggered when the fund exceeds 100 million, at which point the excess is returned to investors. And since launch, we have returned 77 million to our shareholders. On that note, I will pass over to George, who can talk you through the latest activity over the last quarter. Over to you, George.
Thanks, Lucy. Good morning, everyone. I'm going to focus on the last quarter, so kind of performance, trading activity, attribution, but just going to start with a quick reminder of what we are trying to achieve, and then I'll go into the top 10 and continue with the kind of quarterly update. So we're running a high conviction portfolio of micro cap stocks. We've got a really strong view, always have had a strong view that there's a big mispricing opportunity down at the bottom end of the market. That view is as strong as ever today. So it is a good time for us to be allocating capital sub 100 million. That sub 100 million part of the market, it's actually the bottom 1% of UK listed companies. There's about 400 companies in that universe. So it's about a third of the number of companies, but 1% of the value of companies. And so you can see just from those stats that most institutional capital is not going to go anywhere near these companies. It can't. And indeed, sell-side coverage is either quite low, limited, or non-existent. And so you get this information asymmetry, you get this mispricing, and that is what we're trying to exploit. We do that through a concentrated, closed-ended investment trust, broadly 35 holdings, currently 34. We look to have about half of the NAV, half of the portfolio in the top 10 positions. This kind of goes without saying, but it's a really important message, and I'll come back to it a few times. We are very geared to the outperformance of smaller companies in the UK. So if smaller companies are struggling, the concepts that very, very small companies are going to be, successful and outperforming is unlikely. And so we have been through this period over the last 4 years of tough performance. I think we've done an okay job in that environment, but we're starting to see some really interesting signs in the market that we're getting pretty excited about. We are looking in this trust to exploit the liquidity premium, and what I mean by that is we're looking to buy companies that can compound double-digit shareholder value per annum. When we think about how they compound that shareholder value, it's through one of three different investment opportunities: growth, quality, or recovery. And then what we're looking for is for those companies to compound that double-digit shareholder value over 3 to 5 years, which is our typical holding period. As they do that, they become larger companies. As they become larger companies, they become more investable to the open-ended small cap peer group. Those guys have got big funds. They might allocate a quarter or half or 1% of a fund to one of these micro caps. That's a big trade for these micro caps. They tend to re-rate on the back of that. They tend to re-rate as they go through the 100, 150, 200 million market cap. And that tends to be our opportunity to take profits and potentially exit from our ideas. So we need to be in our closed-ended investment trust because of the illiquidity profile. We need to be in there because we're running this high conviction approach. But the final reason why we need to be closed-ended is what Lucy said already, which is we have a very set view of what the right capacity is for this trust. We think it's broadly 100 million. And so when we get up to 110 million of NAV, we return 10 million to shareholders, or above 10. So we've done returns of 10, 15 and 20 over the past. And as Lucy said, raised 70 originally. We've returned 77 million. And as of the last NAV that's been published, which was yesterday, we've got an NAV of about 80 million today. So I'll move on to the top 10. So this is the top 10 as at the end of June. You can see that conviction that we have in our top 10 positions. And I'm just going to bring these, I'm going to try and bring out our kind of investment philosophy by talking about one growth stock, one quality stock, and one recovery stock. So ActiveOps is a great example of a growth business. We invested in the IPO of ActiveOps at IPO in 2021. It is an enterprise software business. Vast majority of its revenue is SaaS recurring revenue with high retention, very high gross margin, 87% gross margin. That business has been delivering, double-digit ARR growth, perhaps low double-digit ARR growth, recently accelerated, and has been free cash flow positive every year for the last 5 or 6 years. They have just at the end of June announced their first piece of M&A. They've bought a similar business in Australia for a really good price, actually. So the business is basically going to pay for itself based on retention of those customers. I think it IPO'd on about 4.5-5 times sales. We've been through a big derating cycle, despite actually the company not doing anything wrong. Recently, that company has started to re-rate as we've seen interest in I guess, the smaller end of the market come back. We're back up to about 2.5 times EV recurring revenue. So not even EV sales, EV recurring revenue. We think a sensible multiple for these kind of businesses does depend on the market, the fundamentals, the growth, but you should be thinking about 3 to 6 times recurring revenue. And so we're below the bottom end of that for ActiveOps. And so that's a position we've had, as I said, since IPO. We've actually averaged down over the last 3 or 4 years. We can take advantage of these mispricings. The shares got very cheap. They got down to about 60 or 70p, having IPO'd at 168. And actually, I think yesterday or the day before, they re-achieved their IPO price. Supreme Imports, or Supreme, is our quality investment case, our highest conviction quality investment case. So for quality businesses, we're looking for high and improving return on capital. So what we're thinking there is low capital intensity or extremely low incremental capital for additional revenue and profits. So that acceleration in return on capital. Supreme is a manufacturer and distributor of kind of staple goods. Half of the GP is in vaping, so they distribute their own and third-party vaping brands, predominantly to discount retailers. And so highly cash generative, high margins, high return on capital. They've been taking that capital that the profits that they've made over the last few years, recycling them into acquisitions. They recently bought Typhoon Tea out of administration, paid a small premium to kind of stock and trade receivables. And they also bought a drinks business, Clearly Drinks. So you're talking about double-digit free cash flow yield, strong balance sheet. So cheap business that has shown that it can grow. We expect we'll be able to continue to grow, but also generate a lot of cash. And then DF Capital is the example of a recovery investment case. When we think about recovery, we either think about margin recovery, so depressed margins versus history, or we think about asset-backed recovery. And so asset-backed recovery is where we're looking for a business that has a solid asset backing. DF Capital is a specialist lender, so it's got a book value, and we're looking for that book value to be growing. And in DF Capital's case, that book value is growing at about 10% today, so a 10% ROE. We can see over the next 3 or 4 years that ROE improving, so moving up to mid-teens. So that book value is going to be growing at mid-teens, and they're currently trading at about 0.65 times book. So unless the shares go up, that discount to book is going to continue to widen. And actually, if you think about the fundamentals of the business, very attractive net interest margin, about 7%. Growing their loan book, healthy double digits, teens loan book growth. Those are fundamentals that most lenders would love to have, and we think that justifies a premium to book value. So that's a bit of detail on both our investment philosophy and our top 10. Coming on to where we are in the small cap cycle. So this chart shows the Numis small cap performance, and Numis small cap plus AIM. So that's the bottom 10% of UK listed companies relative to the all share, both in total return, going back to 1990. So if the chart's going up, smaller companies are outperforming. If the chart's going down, smaller companies are underperforming. And then we've put the big drawdowns on here in boxes. And what you can see is from September 2021, when we went into that with high multiples on small caps, huge kind of positive sentiment towards small caps. We've been through a big derating as interest rates have gone up. There's very high inflation expectations. We haven't really, we have been through the cost of living crisis. We haven't had a market-wide earnings issue, I wouldn't say. But it certainly in some sectors there have been downgrades, but we've had a very big derating. And so this 50% relative underperformance of small caps versus large caps is a really significant small cap bear market. And so the only similar kind of quantum we can see on this chart is the run into .com. It was a bit different in that small caps were going up, large caps were just going up much more. But that was an 88% relative underperformance. We got down as large as 50 in March of this year. So interestingly, we've bounced off those levels, and we will see if that's a sustained bounce. It's impossible to be clear on that, but I think all of the building blocks are in place for that to happen. The final point, the two final points I'll make on here are one, the quantum of the opportunity if we do enter a new small cap cycle is massive. So from 2009 to 2021, smaller companies delivered about 500% total return performance, double the UK, the all share total return. And actually the cycle coming out of .com, which I'd say is more similar to what we're experiencing today. So the .com to 07 cycle, small caps outperformed by 4x large caps. The second point I was going to make was that whilst we like to think that this is a UK specific problem and that the structural concerns around smaller companies and liquidity is specific to the UK, this is a global dynamic. The Russell 2000s underperformed the S&P. European small caps have underperformed European large caps, both at aggregate level and also within individual countries: Spain, Italy, Greece, France, Germany. Chinese small caps have underperformed. Taiwanese small caps have underperformed. I didn't go through every single market I could find, but the only market I could find where small caps have outperformed large caps over the last 4 years was India. And so this dynamic is a cycle. It tends to be geared to interest rates. And hopefully, as I've said, we're emerging from that. What gives us confidence? We've been talking to clients for 18 months about the beginning of a new small cap cycle, and the feedback we broadly get is we can see they're really cheap. We can see that they're unloved. Sentiment towards them is very negative, and positioning is very depressed. But we need to see a catalyst. We want to know what this kind of magic catalyst is that drives the rotation. And obviously that's not something we can provide. So, I do think the last quarter's performance is really interesting. One, because we've substantially outperformed the small cap benchmark, and indeed our NAV has outperformed UK large caps. We've also outperformed global equities, both US equities and the MSCI All World Index. So that's interesting on its own. It's also interesting because it's the first quarter that this has happened since the second quarter of 2021, which obviously brings us back to the previous slide where we've shown this horrendous cycle. But it's been one-way traffic for 4 years. There's been 2 quarters where small caps have kind of performed 1 or 2% above large caps in the UK. We haven't seen this evidence of a kind of material step up. And I think if we get another quarter like this, then people will start to build conviction that this new cycle is in place, and we'll start to see the flows coming in, and the flows are then what makes this, kind of self-fulfilling. So that's where we are in the cycle. Moving on to performance, it's quarterly updates. We've added the 3-month performance in there. Short-term performance, we are very happy with. As I've said, it's not been the easiest market to be operating. A micro-cap trust that's benchmarked against a small cap benchmark that goes up to about 2.5 billion. That's been a real drag on performance in the 3 to 5 year period. We had the 1 year September 21 to September 2022, where we substantially underperformed. And so that's undermining that 3 and 5 year performance number. Since inception, the performance is something we're very proud of. We think it points to our right to exist as a small investment trust, which is very important. And we would flag that we've almost doubled the market return since inception, which is a great place to be. So moving on to what has driven that performance in the last quarter. So Reynolds is our top performer. Reynolds got bid for by private equity. Going back to our philosophy, Reynolds we bought as a classic recovery investment case. So Reynolds is an engineering company. They manufacture chains on a global basis, chains for example, Amazon distribution centers. They also do the chain that spins a warhead when it comes out of a nuclear missile, when it comes out of a submarine. So these are obviously mission critical, highly engineered chains. We bought this business as a recovery investment case to press margins versus history. We actually transitioned it to a growth investment case because the management team had initiated a highly accretive buy and build strategy. There's lots of chain businesses out there with customers, and there's no one consolidating those businesses. Private equity has recognized that and stepped in and acquired the business. We have achieved about 170% premium from our average in price. ActiveOps I've mentioned in one of our top 10. That was a big contributor to performance in the last quarter. As a sign of what's happening in microcaps at the moment, those shares have nearly done 100% from the April low of about 82p to where they are currently. So you can see, and post some results and an acquisition, that company's flipped from being pretty easy to find stock into to extremely difficult. Just struggling to read that. So ActiveOps, and then I mentioned Gear for Music on here as well. So got a comment on it for the trading activity, but it's a really interesting business. We've bought that as a recovery investment case. We could see that transitioning in time to a quality growth investment case, but that's one that we've been building a position in recently. And then on the negatives, litigation capital has been a negative contributor for us both in the last quarter and the prior quarter. So litigation funding business has got a very good long-term track record of delivering strong IRR return on those investments. They've had a bit of a string of failed judgments, challenged judgments, and in some cases failed judgments. So I think 3 or 4 cases in the last year have failed, which alongside them having to postpone their US roadshow to raise their third fund. They tend to raise those funds from US endowments. US endowments clearly have had a bit of a change in their funding requirements. There's also been some tax changes around litigation funding. So it's quite a hard environment to go out and raise a fund. So they've postponed that third fundraise. And clearly the cash proceeds that they were expecting to get in the last 12 months have been much lower than what's actually happened with those failed judgments. So the market's been pretty harsh to this. I'd say it's now trading at a big discount to invested capital. Now, clearly, a view on invested capital does suggest that we believe that the company will continue to win cases, and we can't be sure of that. And it does have some leverage, and so that adds some risk into the investment case as well. But we do think that we're not going to get carried away with the last 4 cases and assume that there's zero value creation going forwards from here. Again, I'd go back to my comment about overall the long-term track record of this company being very good, but we will wait for the prelims in September to really dig into the drivers of those failed cases and our view of a very bearish kind of downside view of invested capital before we make a decision on how we're going to trade that. Just coming back to long-term performance, so this chart shows our annual performance for every year since IPO. So the first period was from December to the following September, so a 10-month period, and the last period here is It's actually a 9-month period. It says 6 months on there, but that's a mistake. So that's September 24 to June 2025. So these are 11 trading periods, if you like, with 9 of those being 12-month periods bookended by shorter periods. So keen to flag that in 9 of those 11 periods, we've delivered positive NAV performance. And in 9 of those 11 periods, we've delivered positive relative performance to the benchmark. That's despite a range of different kind of macro conditions. So you can see style bias has moved between growth and value. We've outperformed in both. Interest rates can be neutral, rising or falling. We've managed to deliver strong performance in both of those environments as well. And similarly, UK economic growth can be above or below trend. It doesn't seem to have a significant impact. What does is the presence or lack of presence of a small cap premium in the UK market. So a small cap premium is smaller companies outperforming large companies. And if it's more than 10% plus or minus, then we've used this double signal. So the years where we have a negative small cap premium are very difficult for us to drive positive relative performance. We've never underperformed in an environment where we've got positive small cap premium. So that's why we're very excited about where we stand today, not only because when we look at the portfolio and the companies we've got in the portfolio and where we've managed to acquire them over the last few years, but also that this run of smaller companies underperformance, which is uncommon. So if you look at the 22 years prior to 2021, smaller companies outperformed 2 years in 3. And we've had a run of none from 4. So it isn't typical. We accept there are some structural drivers here as well. There always have been in the past. My view is it's more cyclical than structural. And we're pretty excited about the performance that we think we can deliver in a more positive environment. What have we been buying recently? So actually the only new position on here is Microlise. Got 35 stocks. I think, we tend to think about 4 to 8 new positions a year. Top end of that, if there's a bit more M&A, bottom end of that, if it's a tougher market, well, I'd say top end of that for M&A and IPOs, bottom end of that if liquidity is lower. So Microlise was a business we actually met at their IPO in 2021. We decided not to invest, but we admired the business. It's got a dominant market position in the provision of services to large fleets. So if you want to manage a large fleet of more than 500 trucks, you need telematics and you need software to manage those fleets. They've got about a 60% market share of large fleets, including all of the top 15 retailers in the UK and about 90% share in the UK grocers. They've delivered double-digit ARR growth over the last 3 or 4 years. For a business that's got a dominant market share, it's probably under-earning. Low teens EBITDA margins for a SaaS business is quite low. So that suggests a lot of cost is going into sales and marketing and product development, which is great. But it does suggest to us that over the medium term, profits can grow faster than revenue. That business is trading on about 2 times recurring revenue. Got very, very high retention of their customers, so less than 1% churn per annum over the last 4 or 5 years, despite what they experienced last year, which was a cyber attack and an outage of their product. So fundamentally a very good business. It's derated. We think it's derated to a point where actually the price now reflects very limited growth going forwards, and that's enabled us to build an initial position. Traxys is another software business, also transport, but trains in the UK and US. That was a new position from the prior quarter that we built on weakness around some negative EPS momentum. Pretty excited about what that company can deliver over the next couple of years. And again, we've bought that on a very reasonable, very depressed multiple of profits, given the short-term EPS momentum. I mentioned Gear for Music that we'd topped up. What drove us to top that business up was having built the position over the last probably 2 years. So the background to this business is through COVID, it's an online retailer of musical instruments, got about 25% market share of that online market, which is about 10% of the total market. Through COVID, obviously, didn't have to pay much to acquire customers and saw a lot of growth. Market got quite carried away with that opportunity, so the market cap got up to about 210 million. Post-COVID, the growth rolled away. Not only did the growth roll away, but lots of businesses, online businesses, had stocked up on inventory, so the market became very competitive. So gross margins also kind of deteriorated and profitability deteriorated quite rapidly. The market cap of that business went from 220 million down to 20 million, which is pretty remarkable. And since then, they've been rebuilding, delivering to expectations broadly. It's been a bit soft, partly because of the very aggressive nature of some of the competitors. They announced in the first half of this year that the most aggressive UK competitor and the most aggressive European online competitor have both gone into administration. They've actually bought some of the assets from the UK business. So they're now talking about a more rational market. We think they can go forward, start to demonstrate, one, a bit more growth, because they'll take the share from those businesses that have exited, but also show some gross margin accretion. And actually, the larger peer in Europe delivers 10% EBITDA margin. So that gives us quite a lot of comfort that business can continue to deliver margin upside. And so we built that position. The other two I'll touch on. Sylvania Platinum is quite a recent addition for us. We've got a view on the supply side of platinum. Sylvania Platinum's very geared to the platinum price. It's got a great model, so low cost extraction of PGMs from old mine dumps. Huge amount of net cash. There is a bit of capex ongoing, but cash generative business. And as I said, very geared to the platinum price. And then IG Design Group, I would argue it's a bit of a failed investment case for us. So we bought it on a recovery basis. We lost confidence in the margin recovery opportunity for their US business late last year. The market already recognized that, so the share price wasn't in the right place for us to exit. But we had a view about what it might cost that business to exit the US business. They announced in the last quarter that they've got a business to take that US business on and sell it. IG is actually geared into any profits that company makes. We don't have a strong view on that, but we thought they'd have to pay, a reasonable sum for someone to take on that business, and they haven't. And that leaves a European and an Australian high return on capital, not hugely high growth, but high return on capital business that we think in the market cap today is probably got a negligible EV, approaching, probably approaching zero. And so we'll wait for the prelims, which are coming out later this month, and then take a view on what the implied enterprise value is for what we think is an okay business. So that just leaves me to kind of wrap up and say where I think we are. So we've been through this really tough small cap cycle. I think there is quite a lot of evidence now, both top down and bottom up, that we're coming out of that. UK consumer confidence is improving. Consumers are well capitalized. Corporates are well capitalized. There's a business barometer survey. I think it's Lloyd's who do it. It's actually, directionally correlates pretty closely with GDP on a forward 6-month basis. That's actually the June number for that was at a post-Brexit high. And so, that's what I'd say about top down. Bottom up, we are seeing much more interest for micro caps. It is harder to put capital to work. And I think all of that is supported, certainly in the last quarter, by the weakness of the dollar or the strength of sterling. Gas prices continue to fall. Clearly, UK consumers are very geared to gas prices. And interest rate expectations are pretty low today. 3-year swaps are well below 4%, 3.6, I think. So that you can start to see mortgages, 3.8, 4% 3-year mortgages. So those are the kind of numbers we need to get the UK domestic economy growing again. And then on the portfolio, it's a high growth portfolio. If you take the portfolio as at the end of March, afraid I don't have the number for June yet, but at the end of March, our portfolio had delivered earnings growth per annum for the last 2 years of 25%. So this is a high growth portfolio. It trades on a 7% free cash flow yield. It's predominantly net cash. is predominantly free cash flow positive. And when you take into account the discount that we trade on, that 7.3% free cash flow yield moves out to about 9%. So I'll leave it there and open up for questions.
Fantastic, George. Thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. George, Lucy, as you can see, we have received a number of questions throughout today's presentation. And Lucy, if I may now hand back to you to chair the Q&A, and I'll pick up from you at the end. Thank you.
Thank you very much. George, we've got lots of good questions here for you, so brace yourself. Are you concerned about the number of takeovers and companies relocating?
So takeovers, yes, a little bit. I don't mind takeovers when the price is right. And I mentioned Reynolds. We also had Science and Sport taken out in the prior quarter. We had Windward and Aquis the quarter before that. So there's been quite a bit. And if I think about what that was as a percentage of NAV for microcap, it's probably close to 20%. So that's 20% in the last 9 months. Aquis was a good price. Windward was a good price. So very, I don't have an issue with that. Clearly, well, no, I don't have an issue with either of those. Science and Sport and Reynolds are frustrating, I think, because we've got in Reynolds a decent stake. We had a good stake in Science and Sport. Science and Sport had clearly turned the corner on their recovery, having been mismanaged for quite a long time. Great brand. So I felt that had a long way to run. But we didn't have enough of a stake to block that. And Reynolds, I don't know. I mean, it's a great premium for where we bought in. It's not quite where our fair value was. Our fair value was probably another 12 or 15% higher. That said, the opportunity set is rich, so we can take that capital and reinvest it. So there's a kind of silver lining to it there. So that's what I would say about the takeouts. And my broad view on the takeouts is the takeouts will drive people to recycle capital. The market will move up, and we'll go back to IPOs. And the sell side are talking about IPOs already. So that's the cycle of M&A and IPOs. The moves to the US, I think, is more of a large cap thing, because you really need to get into the trackers to make the move to the US logical. I don't think it makes a lot of sense, even if you're large, because a large UK company gets lost, quite frankly, in the US, unless you're very large. But it's not really a dynamic we see that much of in the small cap. The one exception being Maxite. Well, not the one exception, but the one exception for us is Maxite, which we've owned on AIM for a long time. We've made a lot of money on it, having bought around these levels today. We took it up to £10, I think it was, sold quite a lot of our position. It raised quite a lot of money on NASDAQ, and the company operationally has done extremely well. The backdrop around biotech funding in the US has clearly deteriorated, but the shares have performed very, very poorly. And they've actually just delisted from AIM, and I kind of get why. All of the capital's on the NASDAQ list, or most of it was. So I don't think it's a big issue for us, and no, it's not something I'm worried about.
Okay, good. And in light of some of the failures in the sector, for example, Argentex, please could you outline where you see high quality as well as aligned management teams?
Yeah, so we haven't recently been shareholders in Argentex, but we have historically been shareholders in Argentex, and we've also been shareholders in Alpha FX, which we've recently exited for microcap, but we held it from IPO, made more than 10x on that investment. The reason I bring that up is these businesses are geared plays. And so the P&Ls are never quite as simple as they look. And if you think about what those businesses really need to grow, it's capital. And so I think, with financials that are gearing equity to make to make profits, we always need to be cautious. And the same would go for DF Capital, which is our largest position. I personally think the management team there are very capable, ex-GE Capital, ex-Aldermore. It's been a bit of a slog for them, but they've broadly not, they've put one foot wrong, but got through that. So I think judging quality of management is hard, and I think you need to be careful when either a business is leveraging equity or if it's indebted. So less than 5% of our NAV has net debt to EBITDA more than 2 times, and 4.5% of that 5% is in Sigma Rock, which is a business we have owned since sub 100 million. It is now a £1 billion market cap company, deleveraging rapidly. So that's not one we're concerned on. The leverage on the other one's Flowtech Fluid Power, which is a recovery investment case we've got 0.5% in. So I think don't get too carried away with management either way, because it's a hard read, and just have caution around leverage, be that net debt to EBITDA leverage or gearing equity. And then the last point I'll make is we spend a lot of time looking at accounting quality, so tracking aging of trade receivables, operating cash flow conversion from EBITDA, cash tax versus P&L tax, all these kind of red flags, and there are providers we use as well to help us with that. But there's evidence in those numbers as well.
Great, thank you. And I think you've touched on this a little already, but market sentiment appears to have improved somewhat compared to much of 2024. How much is the market now prepared to reflect future earnings inflections that may still be a year or two away?
I think it's a well-timed question, because we're starting to get to the point where we're starting to have future goodwill reflected in some share prices. But I actually think one of the things I personally need to be quite wary of is, having run a portfolio through the last 4 or 5 years and got used to companies trading on double-digit free cash flow yield, single-digit earnings multiples, big discounts to book. That's not normal. And so we shouldn't anchor to what's been a very depressed kind of valuation regime. We're always going to be valuation disciplined investors. And broadly, we look at everything on a DCF basis anyway. We use a sensible discount rate, and I'd say the average upside on our portfolio is probably about 60%. So I don't think the market is reflecting future earnings opportunities today in most companies. There are definitely exceptions, and actually, it's a philosophically pure question, and it's right. But momentum's the short-term driver of share prices, as opposed to valuation. And so the companies that tend to get closer or over fair value would be ones where they've got a good track record of upgrading earnings estimates. Perfect,
thanks. And please, can you discuss your current thoughts on Venture Life and their strategy going forward?
Yeah, really interesting one. So the business was previously a buy and build of what they described as unloved brands. So acquiring brands cheaply. They would take those brands in, internalize the manufacturing, because they have manufacturing capabilities originally in Italy, which then expanded to Italy and Netherlands. And so the combination of having a distribution footprint, internalizing the manufacturing, meant if you were paying 5 to 7 times EBITDA on a business, you got it down to 3 to 5 times EBITDA. And so a really attractive kind of buy and build model. They obviously got a pretty good bid for their manufacturing business. So they sold their manufacturing business for 11 times EBITDA, or are selling their manufacturing business for 11 times EBITDA. They're also disposing of one of their lower growth, original, unloved brands. So Ultradex and Dental make up their oral care portfolio. They've said they're disposing of those. And interestingly, in the notes to the accounts, it says they are confident that they'll do that at a premium to the intangible book value. So what they're actually left with now is less unloved brands, but more kind of energy, women's health, higher growth, diabetes management brands, which they've delivered double-digit like-for-like growth on for the last 4 years. So it's a different proposition. Post the disposal proceeds coming in, I think the sell side have got net cash in the business of about 38 million. So a big chunk of the market cap is going to be in cash. They're going to then, I expect, reinvest that into new brands over the course of the next 2 or 3 years and rebuild scale. It's trading very cheaply given that cash that's coming in, given the performance of those brands. And you can track, they've given you enough data in the financials to track the gross margin of the underlying brand portfolio, and its gross margin has been going up. And with the latest acquisition, H&H should expect another step up in the gross margin this year. So gross margin approaching 50%, EBITDA margins 20 to 25%, load of cash on the balance sheet and trading on, I think, sub 5 times EV/EBITDA. That's a very, very cheap business, and it's actually a business that we topped up post that disposal announcement.
Okay, and how do you handle liquidity risk given the small cap nature of the investments?
So I guess we think about it slightly differently in this trust. So we also manage an open-ended small cap fund, which is a £320 million daily dealing OIC. And clearly daily flows mean that we've got to think about liquidity in quite a different way in that fund. So that fund's a 75 stock portfolio, so less concentrated, and there's very little overlap actually with this fund because we can't take on the illiquidity risk. We are here to exploit that illiquidity. I mentioned active ops, and I mentioned adding to it a couple of years ago at I think we've added to it below 1 times EV sales. So the existence of this trust is to take liquidity risk when others don't want to take it. Keystone Law is a business we've owned since IPO. We've sold it at £8, bought it back at £4, sold it at £7, bought it back at £4.50. That's the cycle of sentiment in the market, and illiquid companies get almost, it doesn't matter on the price, just kind of get it out of the portfolio. So that we're there to exploit it. That said, we obviously need to have a view that we can exit the positions we're going into. What we're not doing is some quasi kind of private equity approach where we look for trade buyers to exit our positions. We don't own more than 10% of underlying positions, and in fact we typically don't own more than 5% of them. So if we get an investment case right, as it grows and re-rates, we tend to be able to exit that to the market, to the small cap funds. That hasn't happened in the last few years because they've been retrenching, but hopefully we go back into that kind of a cycle. When we get our investment cases wrong, then there aren't that many people looking for 30 or 40 million market cap companies that don't have particularly good prospects. And so that we don't have a long tail of stocks at all, but we have to work quite hard to get out of those. And if that means taking 10 or 20% out of the price, so be it. They tend to be very small positions anyway. And so we've done that a few times. It's not been a big part of it, but we've done it. I'd say we do it a couple of times a year.
Okay, and along these lines, how do you assess the quality of governance in small and often founder-led companies? And is there a strong pipeline of investable companies, or are you being more selective in current conditions?
So on the governance piece, I think we spend quite a lot of time on this, and we engage with a lot of boards. But I also think we've always said it's very important that we're pragmatic. UK Corporate Governance Code is what it is. And for most companies, that's quite easy to adhere to. We're a bit more flexible. And so, an example would be you're always meant to have a committee. I think they're called selection committees. I can't remember the exact word. It's escaped me. Every company is meant to have a selection committee so that if the CEO goes, then there's the people in place to run the formal process to replace them. And just a lot of smaller micro caps aren't going to have the personnel to have that there all the time. So it's just an example of where we are pragmatic about how we do it. Corporate governance, I would say in small caps is pretty good. We're normally aligned with founders, and if not, we're aligned with management teams. We're pretty supportive of LTIPs. We're having an argument on one at the moment, but normally, less than 10% dilution over 10 years, geared into TSR, preferably not EPS, but okay if it has to be, and return on capital, or ARR growth or something like that fits the investment case. We're supportive. So in general, we don't have a huge problem with corporate governance in microcaps, and we're in a nice position where if we do own 2 or 3 or 4%, then we can have a sensible conversation, and our view is heard. It's not always taken, but it's certainly heard. So that was the first piece. And the second piece of the question, Lucy, was on...
Is there a strong pipeline of investable companies, and are you being more selective?
Yeah, I think we've been a bit more selective in the last couple of years. So we've probably come from 40 companies to 34. Part of that is the M&A. Part of that is the lack of IPOs. Part of it, I think, is just we've got a lot of conviction in our top 10, and so we don't need the other companies. But I think, look, there's plenty of opportunities for us to go after. The trading activity slide's actually quite interesting, because we would normally have 75% of our ideas in quality and growth and 25% in recovery, and actually we're the other way around in the last quarter. I wouldn't say that would be the case for the last year, but it's interesting that we're finding more recovery ideas. That's not us going out with a macro view and saying we want more kind of recovery and less growth. That's just what's coming through the team and getting into the portfolio. So there's no lack of ideas, but it would be nice. We absolutely don't meet every IPO, and we definitely don't take every IPO. But I think it would be very beneficial for the whole industry, for sentiment, for animal spirits, if people were talking not only about new issuance for IPOs, but access to growth capital. I think is really important for our businesses.
Great. And one final one. How is the team incentivized to deliver long-term performance for shareholders?
So the team is incentivized through a performance fee on the fund. So that is, we take 15% outperformance of our benchmark. There's a high watermark. Off the top of my head, the high watermark was from April 2021. I would say we're about 15 or 20% short of that high watermark. So we'd need to outperform by that order of magnitude before we get back into a performance fee. Then a performance fee starts accruing, but we never take that performance fee until we return capital, and our NAV has to go up from 80 to 110 minimum for us to return capital. So what's that? That's probably 40%. So we need to go up by 40% and outperform by 20% to be even starting to accrue and return a performance fee. So I guess that's the crude piece. I think the softer piece is that the three of us, Anna, mine, and myself, who are the PMs on this, we love the job. We run this and another fund, and we find it enjoyable finding these companies and putting them in. So, it's a great trust. And the last point I'd make maybe on it is, we've done a few of these investor meet calls, but we are we know that the discount, I mean, to me, it's crazy. It's 17% discount. Other investment trusts are trading much tighter. We have a daily NAV. It's all listed. So it is a board priority. And one of the levers we can pull is marketing. And so that is something that we're looking to kind of step up. And this is the first part of that. But we're going to go broader and wider. And building retail participation in the trust is a priority over the next couple of years.
Great, thank you. I think that's everything from us, Alex.
That's correct, Lucy and George. Thank you for addressing all those questions for investors today. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. But George, before I redirect investors to provide you with their feedback, which I know is particularly important to the company, could I please ask you for a few closing comments?
Yeah, absolutely. So I think we've got a trust that absolutely kind of does what it says. We invest right down the bottom end of the market. It's thawing. We've built a brilliant portfolio. I'm really happy with the portfolio we've got today. And if we can see some normalization of small cap performance over the next couple of years, then I think we're really well placed to deliver good performance and hopefully return capital to shareholders.
Perfect. George, Lucy, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of River UK Microcap Limited, we would like to thank you for attending today's presentation and good morning to you all.